So we're looking at a company today that just fired nearly 1,000 people in the span of just 3 months.
Right. 1,000 people. It's intense.
Yeah, they were basically battening down the hatches, slashing operating expenses by 1 billion krona and hoarding inventory like a long winter is coming.
Which is a classic defensive crouch from a legacy telecommunications giant. They're just trying to protect their profit margins in a totally stalled market.
Exactly. But then you look at what the outgoing CEO is actually saying on his way out the door, and the narrative completely flips.
Oh, totally.
He is betting the entire future of this 150-year-old company on a straight-up sci-fi vision of autonomous drones, robot-run factories, and artificial intelligence leaving the data center to take over the physical world.
It is a remarkable contradiction to watch play out in real time on an earnings call, honestly. You have a management team executing this ruthlessly pragmatic, short-term survival strategy while simultaneously pitching a wildly ambitious long-term technological revolution.
And that tension is exactly what we were going to dissect today. Welcome to the Deep Dive. We are putting on our Talk Tickers hat today for a data-forward, highly opinionated breakdown of Ericsson's Q2 2026 earnings call.
Ticker symbol.
ERIC.
Right. We have the official transcript, the summary notes, and a very specific mission for you today. We are going to cut through the heavily legally vetted corporate speak and figure out what these numbers actually mean for your portfolio.
Because that's the whole point, right? Making it actionable.
Exactly. We are going to start with the headline numbers, explore the hidden story driving those results, analyze management's guidance for the rest of the year, and then leave you with a concrete, actionable bottom line.
Before we even look at a single spreadsheet cell, though, the broader context here is critical. Ericsson is standing at a major crossroads.
Yeah, Börje Ekholm is leaving.
Right. The CEO who spent the last decade pulling this company back from the brink of irrelevance and restructuring it into a 5G powerhouse, he's handing the reins over to Per Narvinger this October.
So this Q2 report is essentially Ekholm's final major scorecard. Exactly. And he is desperately trying to cement a legacy pivot before he hands over the keys.
Well, let's look at that scorecard then. The cold, hard reality of the current market. Let's start with the top line. Net sales came in at 52.7 billion Swedish krona.
And just for context for everyone, we will be dealing in SEK today, given that is their reporting currency.
Right. Good point. So if you pull up a stock terminal and just glance at the press release, the headline looks grim. It shows a 6% reported decrease in sales year over year.
Which sounds terrible.
It does. If I am holding a stock and I see revenue dropping 6% in a single quarter, my immediate instinct is to look for the sell button.
Sure, which is exactly why relying on top-line reported numbers for massive multinational infrastructure companies is incredibly dangerous.
Yeah, a 6% drop looks like a structural failure.
It does, but when you look at the geographic distribution of Ericsson's revenue, they sell their radio equipment globally, right? In North America, India, Europe, Southeast Asia.
So they are collecting revenue in US dollars, euros, rupees, yen.
Exactly. But they have to convert all of that back into Swedish krona for this earnings report. If the krona strengthens against those currencies, the reported revenue looks lower, even if they sold the exact same number of physical antennas.
Right. And currency isn't the only distortion here either. There was a massive accounting anomaly in the year-ago quarter that makes this current quarter look artificially weak by comparison.
Yeah, in Q2 of 2025, Ericsson recorded a massive one-time settlement benefit in their intellectual property rights division.
The IPR division.
Right. They basically won a major patent dispute or signed a massive catch-up licensing agreement, and all that cash hit the books at once.
Ah, gotcha.
So when you strip away that one-off windfall from last year's baseline and you neutralize the currency exchange swings we just talked about, the organic decline in sales is actually just 1%.
Wow. Okay, so they went from looking like they are bleeding out 6% of their revenue to essentially running flat.
Pretty much. A 1% dip is a rounding error in the telecom infrastructure world.
Yeah, I mean, it means the core business operations, the actual manufacturing and deployment of network gear, is holding remarkably steady in an environment where major telecom operators like AT&T and Vodafone are notoriously tight-fisted with their capital expenditures right now.
Exactly. The top line is resilient, but the income statement gets much more complex as you move down. Diluted earnings per share hit 1.22 SEK, down from 1.37 SEK in the same quarter last year.
Okay.
And net income dropped from 4.6 billion to 4.1 billion SEK. So the absolute bottom line profit is undeniably taking a hit.
Right. But the metric that completely defies gravity here, and the number that management honestly spent the most time highlighting on the call, is the margin.
Yeah, the margin story is fascinating.
Because despite the drop in overall sales volume, their adjusted gross margin actually increased. It went from 48.0% last year to 48.4% this quarter, and their adjusted EBITDA margin held steady at 13.1%.
That 0.4% expansion in gross margin is probably the most impressive operational feat in this entire transcript, honestly.
Why is that so hard to do?
Well, in the hardware and infrastructure business, there is a concept called operating leverage. You have massive fixed costs.
Like factories and stuff?
Yeah. You have to pay for the semiconductor fabrication, the assembly factories, the R&D labs testing 6G prototypes, and the salaries of tens of thousands of engineers.
Right.
So when your sales volume drops, you have fewer dollars coming in to cover those exact same fixed costs. Normally, your margins collapse. It's called deleveraging.
Ah. Okay, so the fact that they expanded gross margin while sales declined means they're executing a surgical, highly aggressive cost-cutting campaign.
Exactly. You can see it in their operating expenses, which they slashed by a full billion SE year over year, bringing them down to 19 billion SEK, excluding restructuring charges.
And this brings us back to the human cost we mentioned at the very beginning of the deep dive. They dropped headcount by nearly 1,000 employees in just 3 months.
Yeah.
They went from over 87,500 people in March down to roughly 86,500 in June.
And CFO Lars Sandström was very direct about this on the call. He explicitly stated that inflationary wage pressures across their global workforce are being offset by cost reductions driven by these headcount reductions and broader efficiency measures.
So they are physically shrinking the footprint of the company to maintain that 13% EBITA profitability target.
They absolutely are.
I mean, Wall Street inherently cheers for headcount reductions because it immediately juices the margins for the current quarter. But looking at the long-term viability of this company, there is a serious risk here.
Definitely a risk.
Because Ericsson's entire economic moat, their entire competitive advantage against rivals like Nokia or Huawei, relies entirely on staying ahead in research and development.
For sure. They have to write incredibly complex network software, design custom silicon chips, and author the literal global standards for 6G.
Right. So if you keep firing people to protect your quarterly margin, you risk eating your seed corn. You lose the engineering talent required to invent the products you need to sell 5 years from now.
And that is the perpetual tightrope for a mature technology company in a flat market. The defense management offered on the call, and it was a point scrutinized by several analysts, by the way, is that these are not indiscriminate R&D cuts.
Okay, so what are they cutting?
They are pointing to a metric they call delivery efficiency. A significant portion of this margin improvement, particularly in their software divisions, came from automating how they deploy and maintain their products.
Oh, I see. So they aren't necessarily firing the people inventing the next generation of radios. They are automating away the jobs of the people who manually install and update the software on the current radios.
Precisely. Think about it in the past. Upgrading a telecom network might have required sending teams of highly paid field technicians in trucks to manually interface with hardware at cell sites.
Right.
Or having armies of IT staff manually configuring software on proprietary servers. But Ericsson has been aggressively shifting to cloud-native software architecture.
So it's all done remotely now.
Exactly. They are using automated deployment pipelines, what the software industry calls CI/CD, or continuous integration and continuous deployment. When a telecom operator wants to update a feature on their core network, Ericsson systems can now push that update out automatically to thousands of servers with minimal human intervention.
Oh, wow. So they quite literally require fewer human beings to deliver the exact same amount of operational value.
Yeah, that's the claim. Furthermore, they divested a subsidiary called iConnective back in 2025. That naturally brought the total headcount and the baseline operating expenses down as well.
Right. But the reality remains, you cannot shrink your way to long-term greatness. Automation and divestments can protect the bottom line for a few quarters, maybe a few years. Eventually, the top-line revenue has to start growing again.
Which forces us to look under the hood at the macroeconomic forces pulling Ericsson in opposite directions right now. Because the margin resilience we just discussed is happening despite a brutal surging wave of component inflation.
Yeah, let's get into that. Because the biggest dark cloud hanging over this entire earnings call was this semiconductor market.
Oh, absolutely.
We're in the middle of an unprecedented global boom in AI infrastructure right now. The hyperscalers, Google, Microsoft, Amazon, Meta, They are spending tens of billions of dollars building massive data centers.
Yeah, it's a gold rush.
And to build those data centers, they are vacuuming up the global supply of memory chips, advanced packaging capacity, and specialized semiconductors.
And this creates a massive supply chain collision for Ericsson. While a cell tower radio unit is very different from a data center AI server rack, they share many of the underlying foundational components.
Right, a chip is a chip.
Basically, a modern 5G baseband unit requires incredibly fast SRAM and DRAM memory chips to buffer and process radio signals. It requires power management integrated circuits. It requires specialized networking chips.
So when the AI industry buys up all the capacity of the semiconductor foundries in Taiwan and South Korea, the cost of those raw materials skyrockets for everyone else.
Exactly. And CFO Lars Sandström didn't mince words about this. He said, quote, "Input costs increased further in Q2. The financial impact from this will start to build up gradually in the coming quarters," end quote.
Yeah, he specifically named semiconductors as the culprit. And you can see the absolute strain this is putting on the business when you look at their cash flow statement. Their free cash flow before mergers and acquisitions tanked.
It really did.
It fell from 2.6 billion SEK this time last year all the way down to a measly 0.4 billion SEK.
A cash flow drop of that magnitude is a flashing warning light for investors, and it directly connects to the single biggest mystery in this Q2 report, the inventory buildup.
Oh, the 5 billion SEK question.
Right. Ericsson added 5 billion SEK to their inventory in a single 3-month period.
Which is wild, because in a declining or flat sales environment, a massive inventory build is usually terrifying. If a retail company reports flat sales, but their warehouses are suddenly bursting with $500 million worth of unsold merchandise, investors panic.
Yeah, because it usually means management misjudged demand, built products nobody wants, and now that cash is trapped in a warehouse gathering dust, rapidly losing value.
But Sandström pushed back hard against that interpretation, didn't he?
He did. He claimed this was a deliberate, quote, tactical move. He explicitly stated that the vast majority of that 5 billion SEK is comprised of finished goods that are staged and prepped for planned deliveries in the third quarter.
Right. He framed it entirely as a timing issue, like just making sure they have the physical hardware ready to meet rigid customer deployment schedules. I gotta say, I am highly skeptical that this is purely about delivery timing. Is hoarding 5 billion SEK in finished goods really a tactical masterstroke of supply chain management, or is this just panic buying?
That's a very fair question.
When Felix Henriksen, an analyst from Nordea, pressed on this specific issue during the Q&A, Sandström did concede that a portion of that inventory build is connected to higher component costs, though he maintained it wasn't the majority driver.
But think about the operational reality of running a global supply chain right now. If your procurement department is looking at the semiconductor market and they know with near absolute certainty that memory chip prices are going to spike over the next 6 months because of the AI data center build out,
right,
the most rational thing you can do is buy every single component you can get your hands on today.
You would pull all your component orders forward, run your factories at max capacity, build the finished radios, and shove them in a warehouse in Texas or Stockholm.
Exactly. Yes, it annihilates your free cash flow in the current quarter because you are paying for all those parts up front, but it locks in your cost basis before inflation destroys your profit margin later in the year.
That actually makes a lot of sense. And in the telecom infrastructure business, the penalties for missing a delivery window are astronomical right now.
Oh, massive. If a major carrier like AT&T schedules a massive tower upgrade across the American Midwest, they have lined up thousands of unionized tower climbers, secured municipal permits, scheduled crane rentals.
It's a huge logistical operation.
Huge. So if Ericsson turns around and says, sorry, we don't have the radios ready because we were trying to optimize our quarterly working capital metrics, the financial penalties written into those contracts are severe.
Not to mention the reputational damage.
Exactly. It could cost them the next decade of business with that carrier. So management is likely doing a mix of both. They are securing supply ahead of known inflation, and they are staging massive amounts of heavy equipment for a condensed delivery schedule in Q3.
So for anyone analyzing this stock, this inventory number is the single most important metric to watch next quarter.
Definitely.
If that 5 billion SEK in stockpiled gear doesn't translate into recognized revenue in Q3, then the tactical delivery excuse falls apart completely. It would mean they misjudged demand, and they are sitting on aging hardware that will eventually have to be written down.
Exactly right. That is the headwind, the brutal reality of inflation and trapped cash. But the Q2 report also showcased some massive tailwinds, specifically in areas of the business that don't require pouring concrete or climbing towers.
Yeah, let's talk about the Cloud Software and Services segment, or CSS. It was the absolute star of the quarter.
It really was. CSS grew 5% organically. They reported growth across every single geographic market area they operate in.
Which is great, but it's the profitability of this growth that is actually staggering. They hit a record 12.4% adjusted EBITA margin for CSS. Management described this as a new high level of performance.
The context here is vital for you as an investor to understand. Historically, the Cloud Software and Services division has been a massive drag on Ericsson's overall profitability. For years, it was a bloated, unprofitable mess.
Oh, really?
Yeah, it was a collection of disparate software products, legacy billing systems, and consulting services with terrible commercial discipline.
So they were essentially doing highly customized, bespoke software integration for every single telecom operator, which meant they could never achieve economies of scale.
Exactly. Every deployment was a custom consulting job rather than a scalable software product. But before incoming CEO Per Narvinger took over the Networks division, Börje Ekholm tasked him with leading the turnaround of this specific CSS division.
Ah, so this is his baby.
It is. Narvinger instituted ruthless commercial discipline.
Right.
He walked away from unprofitable contracts. He standardized the software portfolio around cloud-native architectures that could be deployed automatically, which ties back to the headcount reductions we discussed earlier.
Right. So seeing this division not just achieve profitability, but hit a 12.4% margin is a massive vindication for Narvinger.
Absolutely.
It essentially serves as his resume for the CEO job he is taking in October. It proves to the market that he knows how to take a sprawling, unprofitable operation, instill operational rigor, and extract high-margin cash flow.
And the high-margin hits didn't stop with CSS. We need to dissect their intellectual property rights business, their IPR licensing deal.
Yeah, I love talking about this part of the business.
For investors who might not be deep in the weeds of telecom patents, IPR is an incredibly lucrative, almost hidden engine of cash generation for companies like Ericsson, Nokia, and Qualcomm.
Because Ericsson employs thousands of researchers who spend their entire careers developing the foundational mathematics, the wave modulations, and the error correction codes that make cellular communication possible, right?
Right. They write the literal standards for how a 5G connection is established and maintained.
And these are known as standard essential patents, or SOPs. If a company wants to manufacture a device that connects to a cellular network, whether it's a smartphone, a smartwatch, a connected car, or a point-of-sale terminal, that device must communicate using the specific protocols that Ericsson invented.
Yep. They cannot build a workaround. The physics of the standard dictate that they must use Ericsson's patented technology.
And because their technology is baked into the global standard itself, the law dictates they must license it on fair, reasonable, and non-discriminatory terms.
But they absolutely get to license it. In July 2026, Ericsson announced they signed massive new multi-year agreements with a top 10 global smartphone vendor and a major payment terminal provider.
Think about the payment terminal for a second.
No.
When you tap your credit card at a farmer's market or use a handheld tablet to pay at a restaurant, that device often has a cellular modem inside it to securely process the transaction.
Exactly.
Every time one of those terminals is manufactured, a fraction of a cent or a small percentage of the component cost flows back to Stockholm.
These new deals brought Ericsson's annualized IPR run rate to a staggering 13.5 billion SEK. That is essentially pure high-margin recurring software revenue. It flows almost entirely straight to the bottom line.
Wow.
Yeah, so in a quarter where they are battling semiconductor inflation and flat hardware sales, having a 13.5 billion SEK recurring revenue stream from patents provides an incredible financial cushion.
Okay, so we have established the tug-of-war happening in the current financials. Hardware margins are being squeezed by inflation, while software and patent royalties are booming. But if you only look at the financials, you miss the entire strategic narrative of this earnings call. The real story, the thesis that Börje Ekholm is trying to permanently attach to Ericsson before he steps down, is the AI uplink pivot.
This is where it gets really interesting. Because for the last 2 to 3 years, the stock market has heavily punished telecom infrastructure companies because the initial 5G build-out just kind of stalled.
Yeah, the carrier spent billions buying the first wave of 5G gear, but consumers didn't really care. If your Netflix stream loads instantly on 4G and your Spotify never buffers, there is no pressing consumer demand for millimeter wave 5G speeds.
Exactly. And because the carriers couldn't monetize 5G effectively with human consumers, they stopped buying new equipment from Ericsson.
That is the dominant bear case that has compressed Ericsson's valuation for years.
Yeah.
But Ekholm is arguing that the market is completely misinterpreting what 5G was actually built for.
He is. On the call, he stated that the next phase of generative AI is moving out of the data center and into the physical world. He used a very specific, dense technical phrase. He said, quote, "Uplink will dimension mobile networks," end quote.
Uplink will dimension mobile networks. That is the phrase that every investor needs to understand because it is the entire foundation of their future growth strategy.
Let's break down the mechanics of that.
Yeah, please. Since the invention of the smartphone, our mobile networks have been built asymmetrically. They are fundamentally designed for downloading.
Right. When a human user is interacting with the internet, they are pulling massive amounts of data down from the cloud. You are streaming a 4K movie, scrolling through high-resolution images on Instagram, or downloading a podcast. The data flowing from the cell tower down to your phone is massive.
But the data you send back up to the tower, the uplink, is minuscule. It's a text message, a quick search query, a click, maybe uploading a single photo.
Exactly. So for the last 15 years, telecom operators have dimensioned or designed their physical networks to have massive, wide-open highways for downloading and tiny, narrow dirt roads for uploading.
But Ekholm's thesis is that the era of the human consumer dictating network architecture is basically over.
It is. Generative AI is rapidly evolving beyond chatbots and text generators. It is moving into physical machines that operate in the real world. We are looking at fleets of autonomous delivery drones, fully robotic logistics warehouses, self-driving vehicle fleets, and workers wearing augmented reality headsets on factory floors.
And the fundamental difference between a human holding an iPhone and an autonomous drone flying over a city is data generation. A drone is not watching Netflix. It is equipped with multiple 4K cameras, LiDAR sensors, and infrared scanners. It is generating gigabits of environmental data every second.
And that drone cannot carry a massive, heavy, power-hungry AI supercomputer on board to process all that data locally. It would drain the battery in 5 minutes. The heavy AI compute has to happen in the cloud, which means the drone has to continuously upload its massive sensory data stream to the network in real time, have the AI model process it, and send a steering command back down, all with near zero latency so the drone doesn't crash into a building.
Suddenly, that narrow dirt road for uploading data is completely overwhelmed.
Yeah.
The network now requires massive, ultra-reliable uplink capacity.
And what specific global technological standard was designed from the ground up at the physics level to handle massive device density, ultra-low latency, and high bandwidth uplink?
5G standalone architecture.
Bingo. Ericsson is arguing that as soon as enterprise companies deploy these physical AI systems, the telecom networks will instantly congest. The carriers will have absolutely no choice but to rip out their legacy gear and buy high-performance uplink-optimized 5G radios.
And Ericsson is actively proving this thesis in the real world today, aren't they?
They are. Management didn't just spin a sci-fi yarn on the call. They brought the receipts. They anchored this concept with a specific field deployment. Ericsson successfully demonstrated AI-enabled drone sensing, tracking, and video streaming at a major global sporting event at a stadium in Texas.
And the critical detail of that Texas stadium example is that they did not build a custom, private, hermetically sealed Wi-Fi network for those drones.
Right. They ran them on the existing commercial public cell towers, utilizing Ericsson's latest 5G software features. They proved to the major carriers that the technology works right now on standard infrastructure, provided you buy the premium Ericsson hardware and software licenses to enable it.
It is a brilliantly constructed narrative. It reframes Ericsson from a boring, slow-growth utility supplier into a critical, high-tech enabler of the AI revolution.
But as an investor managing a portfolio, you have to separate a compelling vision of the year 2030 from the financial realities of 2026. The timing is everything.
And to Ekholm's credit, he was surprisingly sober about the timing. He admitted that while he sees this physical AI boom as inevitable, they cannot build their current corporate cost structure on a speculative timeline. They are cautiously planning for a flattish market in the near term.
Which brings us to management's official guidance for the third quarter and the back half of the year. There is a glaring contradiction between the volume of gear they expect to sell and the profit they expect to make on it.
Yeah, let's talk about that Q3 guidance.
They gave very specific data points. They expect sales growth in their core networks division to come in above the 3-year average seasonality.
Well, what does that seasonality look like normally?
Well, in the telecom industry, capital expenditures are highly seasonal. Carriers tend to dump their budgets in specific quarters based on weather for tower climbs or end-of-year budget cycles. Guiding above the 3-year average implies a healthy, robust volume of physical equipment moving out the door.
Okay, sounds good so far. But immediately after predicting strong sales volume, CFO Lars Sandström delivered a gut punch to the margin models. He expects the network's adjusted gross margin to drop to a range of 48% to 50%.
Which is a noticeable step down from the margin expansion they just celebrated in Q2.
Right. Selling more products but making less money on them requires an explanation. Sandström blamed this margin compression on a, quote, change in mix, specifically citing a higher share of network rollout projects slated for Q3.
Let's dissect the mechanics of a rollout project because it perfectly illustrates the financial life cycle of a telecom contract. Building a new mobile network site is not a software exercise. It is heavy, physical, industrial construction.
Yeah, a rollout project involves acquiring municipal zoning permits. It involves renting massive cranes. It requires dispatching crews of specialized, highly paid technicians in bucket trucks to physically climb hundreds of feet into the air.
Exactly. They have to haul massive steel antennas and heavy baseband units up the tower, bolt them into place, run the thick physical fiber optic and power cables down the structure, and pour concrete pads for ground equipment.
The profit margins on that initial phase of physical labor and heavy equipment installation are razor thin and sometimes non-existent. Ekholm frankly admitted that the initial phase of a major rollout contract is frequently margin negative. Ericsson often takes a loss on the physical construction just to win the footprint.
But once that steel and silicon is bolted to the tower, Ericsson owns that real estate. They have established the physical footprint.
Right.
2 years later, when the telecom operator realizes their customers are consuming more data and they need to activate a new frequency band or enable a new 5G feature to handle the traffic, they don't have to climb the tower again.
They just call Ericsson, and Ericsson pushes a software update over the air to unlock the new capacity on the hardware that is already sitting there.
And the profit margin on that subsequent software upgrade is astronomical. It requires 0 physical labor and 0 raw materials. It is practically pure profit.
So when management warns about a mix shift towards rollout projects, they are telling investors that Q3 is going to be a heavy construction phase. They are doing the hard, low-margin physical labor now, securing the footprint, with the long-term expectation of harvesting the high-margin software upgrades in the years to follow.
It is the classic razor and blades business model, just executed on a multi-billion-dollar scale with concrete and steel. You lose money selling the physical razor handle to guarantee a decade of selling highly profitable blades.
But this mix shift is colliding head-on with the macro outlook. Management bluntly stated that the overall market for radio access networks will remain entirely flat until the enterprise AI demand fully materializes.
So we have a flat overall market, an increasing percentage of low-margin heavy construction projects, and the delayed impact of the semiconductor inflation we discussed earlier.
Right. CFO Sandström warned that the financial sting of those rising component costs will finally hit the income statement in Q3 and Q4. It is a perfect storm for near-term margin compression.
So the obvious question for an investor is, what are they actually doing to fight this? If your supply chain costs are skyrocketing and your customer demand is flat, how does the business survive the squeeze?
Yeah. Management outlined 3 distinct tactical defenses. The first is engineering-driven, product substitution and redesign.
Meaning what?
When a specific memory chip or power management IC becomes impossibly expensive because the AI data centers are hoarding it, Ericsson's engineers physically redesign the circuit boards of their radios to utilize different, cheaper, or more readily available components that aren't caught in the AI supply chain crossfire.
But that is not a quick fix. You can't just swap a chip on a Tuesday.
Yeah.
You have to re-engineer the board, write new firmware, test it for thermal compliance, certify it with regulatory bodies, and push it through manufacturing. Ekholm noted this hardware redesign cycle takes 6 to 9 months to actually flow through the supply chain and show up as savings on the balance sheet.
Right. So the second strategy is purely commercial, raising prices on new tenders. When a telecom operator in India or Europe puts out a request for proposal for a massive new network build, Ericsson is simply submitting their bids at a higher price point to protect their margins from the jump.
Which is perfectly logical for new business.
Yeah.
But what about the billions of dollars of contracts they're already in the middle of executing?
Exactly. You cannot just call up T-Mobile or Vodafone halfway through a multi-year tower build and declare that memory chips are more expensive, so the contract is now 10% higher.
And that specific vulnerability was heavily scrutinized during the Q&A portion of the call. Jacob Bluestone, an analyst from BNP Paribas, asked Ekholm point blank if Ericsson has automatic inflation pass-through clauses embedded in their long-term contracts.
And Ekholm gave a brutally honest answer. He said no. The contracts are locked in, and there is no automatic mechanism to pass rising material costs onto the customer.
Which leaves them with their third and final defense strategy, attempting to renegotiate existing deals. Ekholm stated they are proactively going to their current customers and initiating discussions to share the burden of the inflation.
I gotta be honest, this is where I struggle to see the leverage. Ericsson is telling investors to be patient, to wait for this incredible physical AI boom that will force telecom operators to radically upgrade their networks.
Right.
But concurrently, they're going to those very same telecom operators who are struggling with their own stagnant revenue and massive debt loads and asking them to voluntarily pay more for the gear they are currently buying. Why on earth would a telco agree to that? Won't they just delay their network upgrades even further if Ericsson tries to force price hikes?
Yeah.
It highlights the fundamental structural weakness of the telecommunications equipment market. Ericsson is entirely dependent on the capital expenditure budgets of a highly consolidated group of heavily regulated telecom monopolies. There are only a handful of massive carriers globally that matter, and they are notoriously ruthless in their procurement practices.
However, Ericsson's counter-argument is that the carriers ultimately have a gun to their own heads. The volume of data traffic on mobile networks is growing exponentially every single year, regardless of whether the carriers are making more money on it.
That's true.
If a telecom operator decides to protest Ericsson's price hikes by stopping their network upgrades, their local network will congest. Calls will drop, data speeds will crawl, customers will churn to a competitor, and the carrier will fail. Ericsson isn't selling luxury goods, they are selling mission-critical infrastructure. It is a tense negotiation, but Ericsson is not operating from a position of total weakness.
So we have dissected the resilience of the headline numbers, the mechanics of the inflation and inventory buildup, the turnaround in the software division, the visionary physical AI thesis, and the sobering reality of the near-term margin squeeze.
Which brings us to the ultimate goal of the Talk Tickers format. It is time to synthesize all of this complex, contradictory data into a concrete, opinionated takeaway for your portfolio. We're looking at the sum total of the Q2 results, the strategic positioning, and the macro environment.
Based on the entirety of the evidence presented, we're declaring Ericsson a cautious hold with a high-yield waiting game.
A cautious hold with a high-yield waiting game. It perfectly encapsulates the dual reality of this stock. Let's break down exactly how we arrived at that conclusion, starting with the bear case.
If you are a skeptic looking to short this stock, there is plenty of ammunition in this transcript.
The near-term headwinds are undeniable and severe. First, the enterprise segment is floundering. Sales in that division plummeted 19%.
Yeah. Now, a portion of that was an accounting artifact from divesting the iConnective business, but even adjusting for that, Ekholm was surprisingly candid.
What did he say?
He admitted that their push to sell private 5G networks directly to enterprise businesses has yielded neither attractive growth nor acceptable profitability. They simply haven't figured out how to crack the enterprise market at scale.
Ouch. Second, the core hardware business, the radio access network market, is dead flat. Telecom operators simply are not opening their wallets for major new expansion projects right now.
And third, that semiconductor inflation is a ticking time bomb on the balance sheet. Management has explicitly warned you that margins will face downward pressure in Q3 and Q4 because of rising component costs and the shift toward low-margin rollout projects.
Right. So if you buy Ericsson stock today, you are knowingly buying into a company that has promised you a margin squeeze over the next 6 months.
But the bear case ignores the profound operational discipline happening underneath the surface. The bull case is rooted in raw execution. This is a hyper-efficient organization.
Yeah, the fact that they generated a 48.4% gross margin while overall sales were declining is a testament to rigorous cost control.
Furthermore, the massive turnaround in the cloud software and services segment, taking a historically unprofitable mess and driving it to a record 12.4% margin, proves that incoming CEO Per Narvinger has the operational chops to extract cash flow from struggling divisions.
And then you have the long-term visionary thesis, the AI uplink revolution.
Which is huge.
If Ekholm is correct, and generative AI rapidly evolves from generating text on a screen to piloting drones, driving trucks, and running robotic factories, the physical infrastructure of the internet has to change. The world will desperately require mobile networks heavily dimensioned for massive, low-latency uplink.
And Ericsson, powered by their massive portfolio of standard essential patents and their purpose-built silicon architecture, is arguably the best-positioned entity on the planet to build the invisible tracks that those futuristic technologies will run on.
But perhaps the single most compelling piece of the bull case for a retail investor sitting on the fence is the sheer volume of cash being deployed to protect the stock price.
Oh, absolutely.
You are not being asked to sit around and wait for this physical AI thesis to materialize out of the goodness of your heart. Ericsson is aggressively paying you to wait.
Let's put a spotlight on the capital return metrics because they are massive.
Yeah.
In this quarter alone, Ericsson returned 8.2 billion SEK to their shareholders.
Wow.
That consisted of a 5 billion SEK dividend payout and 3.2 billion SEK spent directly on share repurchases.
The share repurchase program is critical context when evaluating management's true confidence. A management team that is internally terrified of a structural decline does not spend 3.2 billion SEK buying back their own stock.
No, they hoard it. Share repurchases actively reduce the total number of outstanding shares on the open market.
Which means every single share you hold in your portfolio instantly represents a slightly larger percentage ownership of the entire company and entitles you to a larger claim on all future earnings.
It establishes a firm mathematical floor under the stock price, signaling to the market that management believes the stock is undervalued. Combined with the dividend, which provides a tangible, high-yield cash return, investors are being heavily compensated to weather the current flat hardware cycle.
So here is the final calculus for your portfolio. If you fundamentally believe that the AI revolution is mostly software hype, that it will remain trapped in browser windows, helping people write emails and generate code in data centers, then the physical telecommunications networks do not need a massive, urgent upgrade.
Right. In that scenario, you should likely sell Ericsson because the telecom operators will continue to starve their capital expenditure budgets.
But if you believe that AI is inevitably moving into the physical world, that autonomous supply chains, augmented reality manufacturing, and drone logistics are the actual future of the global economy, then those machines will absolutely require a high-performance, low-latency, high-uplink nervous system.
And Ericsson is currently building that exact nervous system.
It is the ultimate infrastructure play. You don't have to guess whether an Amazon drone or a Google drone wins the logistics war. You are just betting that whoever wins will have to pay the toll operator for the connectivity required to fly.
We have covered the financials, the strategy, and the valuation. But before we conclude, there is one final, highly technical and potentially existential question that was raised during the call that we really need to unpack.
Yeah, this is important. It is an issue that wasn't fully resolved by management, and it represents the biggest long-term risk to Ericsson's dominance.
We discussed earlier how Ericsson's engineers are redesigning their physical circuit boards to combat semiconductor inflation. But Erik Lindholm-Royestål, an analyst from SEB, asked a fascinating question that strikes at the very architecture of how a cell tower fundamentally operates.
Right. NVIDIA, the undisputed behemoth of the AI computing world, recently announced a major strategic push into the telecom radio unit space.
They are aggressively pitching a concept called vRAN, or Virtualized Radio Access Networks. They want telecom operators to stop buying custom-designed hardware from companies like Ericsson and instead build their cell sites using standard general-purpose NVIDIA GPUs running software.
This is a battle over the fundamental hardware architecture of the edge. Ericsson designs and fabricates custom ASICs application-specific integrated circuits. These chips are hard-coded at the silicon level to do one specific thing incredibly well. Process complex, massive MIMO radio waves with near-zero latency and incredibly low power consumption.
And NVIDIA is arguing that a general-purpose GPU, which is a massive array of parallel processors that can be programmed to do almost anything, can run the radio wave processing software just fine, while also having the flexibility to run AI workloads at the edge of the network when the radio traffic is light.
Ekholm vehemently defended Ericsson's custom ASIC approach on the call. He argued that the physics of processing a radio signal require an ASIC. He stated that their purpose-built silicon is vastly more cost-effective, significantly more energy efficient, and offers vastly superior performance in the field today compared to brute-forcing a radio signal through a power-hungry general-purpose GPU.
And he is correct about the current state of the technology. An ASIC will beat a GPU in pure radio processing efficiency every time. He also noted that Ericsson's actual software stack is hardware agnostic. They can run their network software on a general-purpose GPU if a customer truly demands it.
But the underlying tension is palpable, isn't it?
Oh, absolutely.
Because if the massive telecom operators ultimately side with NVIDIA and demand that future networks be built on general-purpose GPUs so they can process AI workloads natively at the tower, does Ericsson lose its ultimate hardware differentiation?
It is the ultimate question of commoditization. If the physical radio unit just becomes a dumb antenna feeding raw data into an NVIDIA supercomputer at the base of the tower, then all the economic value, all the massive profit margins accrue to the GPU manufacturer, not the antenna builder. Ericsson's hardware margins would be under severe long-term threat.
It is the battle for control of the edge in the 2030s. Will the physical infrastructure of the internet be controlled by the companies that specialize in the dark arts of radio frequency physics, like Ericsson? Or will it be swallowed whole by the massive compute platforms like NVIDIA?
It is a critical architectural dynamic that every infrastructure investor must monitor closely over the next 5 years.
And that is exactly the kind of provocative, systemic question we want to leave you with. Infrastructure is never as static as it appears. A cell tower might look like the same boring piece of steel from the highway that it did 10 years ago, but the silicon brains inside those boxes are currently the site of a massive architectural war being fought by the largest technology companies on Earth.
The stakes are incredibly high, and the underlying technology is shifting rapidly.
Keep a very close eye on those Q3 inventory numbers we discussed. Watch to see if the margin compression on the rollout projects is as severe as management guided. And decide for yourself if you believe the physical AI revolution is going to arrive fast enough to save the legacy telecom equipment market. Thank you for joining us for this deep dive. Until next time, keep digging into the data.